Welcome back to Portfolio Playbook. Today is September 6, 2025. I'm Damanick Dantes, founder and portfolio manager at Dantes Outlook. And with me today is Victor Zhou, a portfolio strategist. Victor, a lot's been happening across markets from valuations and currencies to the important role of diversification. So let's jump in. Victor?
Definitely. Yes, let's start with the valuations. Interestingly, an email came in from Deutsche Bank recently pointing out that the US valuations are historically stretched. And looking back 150 years, when valuations were this high, the forward return over the next decade or so are consistently weak. And the last three major peaks, the 10-year real returns were negative.
Yeah, that's a striking stat. And today, much of the elevated pricing actually comes down to the AI narrative. The so-called Magnificent Seven or Mag 7 stocks, they're pulling a lot of weight. And the question now is whether this is a true paradigm shift or just another cycle of overexuberance. Unlike the 2000 tech bubble, though this time it's really concentrated in the US, while Europe and other G7 markets are trading at more moderate levels.
That's a good point. And outside the US, currency have played a huge role. A recent State Street report have noted that the US dollar had fallen more than 9% year to date and back to pre-pandemic levels. This weak dollar boosts returns on international equities for US investors. For example, the MSCI Europe Index has gained 26% this year in dollar terms. Emerging markets are up 21% year to date, and Japan are up 17% year to date.
Yeah, and the sector stories matter too. So I remember you put together some research from BlackRock, and that highlighted that European banks have been surprisingly resilient. So when we talk about diversification and the Magnificent Seven here in the US, when you look abroad, there's also a lot of concentration that makes up for a lot of the rallies. So diversification matters even more. And even though the ECB cut rates, banks are still profitable. And that's especially when rates are stabilizing there near about 2%. Aerospace and defense, they're also benefiting from Europe's renewed spending commitments, while luxury goods and semiconductors are still showing strong pricing power.
Exactly. And add on to that, actually, on the sector standpoint, European financial sector has been particularly strong and rising about 53% year to date. This has largely benefited from the European Central Bank to ease the interest rate. But on the flip side, BlackRock is also cautious on healthcare because of the policy uncertainty and the potential shift that could impact healthcare in the European sector. So it's not just about broad market, sector allocation also matters in this turmoil environment.
Yeah, and that brings us back to diversification, right? So AQR recently emphasized that many traditional diversifiers, think about private equity, real estate, hedge funds, they're increasingly correlated with equities. And their research shows that liquid diversifiers, particularly trend following strategies like what we offer, have historically added true diversification. And that's especially important when you consider extended drawdowns like in 1970s and the early 2000s.
And exactly. So that's why we have leaned into relative strength and momentum strategy in our alpha capture ETF model portfolio. A quick summary. In August, our portfolio was up 2.33%, outperforming its global 60/40 benchmark by 30 basis points. Our US equity has accounted for most of the absolute returns, but we have also seen that our cyclical sector tilt and emerging market exposure were the key drivers. Especially, the Vanguard Emerging Market ETF rose over 3%, outpacing world equity indexes in the benchmark.
And on the fixed income side, our bond allocations outperformed, even though we remain a structurally underweight position there. We saw strong, solid gains from our international government bond ETF and our intermediate term US Treasury ETF. And that compared favorably to the benchmark's bond allocation, which saw more modest gains.
Exactly. And additionally, our inflation hedge also did its job. Some of our cyclical stock exposure saw strong gains, especially in the energy related assets. And our gold position increased almost 5%, to provide a buffer in the midst of macro and policy uncertainty we have seen in the recent months. And that's a good example of using ETF as targeted hedges within the portfolio.
Excellent. And, looking at the big picture, our moderate portfolio is performing pretty well year to date. While it has produced softer returns relative to our global 60/40 benchmark this year, it maintains a stronger long-term Sharpe ratio, and that's risk-adjusted returns since its inception back in 2022. This is largely because of our long-standing U.S. equity overweight, and that's been a source of strong outperformance. So we're essentially taking good profits there and now rotating globally to align with our benchmark. And at the same time, we're being compensated for our active tilts outside of the benchmark, particularly in fixed income recently. If you think about it, there's a lot of dispersion within the fixed income asset class globally, and it's such a vast asset class. So there's a lot of opportunities to choose from. And our aggressive version, which includes our Bitcoin gold rotation sleeve, has surged over 32% year to date. That's pretty strong. That's because, like in the first half of this year, risk off modes triggered really a strong gold rally. So we were able to allocate to risk off and the gold position and then gradually return it to Bitcoin. And I think now we flipped it from the model. So gold has actually produced really strong returns. And our conservative portfolio, it's more of an equal weighted. It also has allocation to gold, fixed income equities. That's up about 9.5%. So that's balancing yield and capital preservation. And just to clarify, our moderate portfolio is the flagship portfolio. It forms the core of the aggressive version. And for aggressive clients, they can allocate to our moderate and attach to crypto strategy for enhanced returns. So here, there's a various ways to participate in our models. And, I firmly believe in diversifying across asset classes as well as diversifying across strategies. And concentration matters only when you're compensated for taking those outside bets.
That's a great summary, Dominic. So the takeaway for today's podcast: US equity valuation are stretched, which may challenge long-term returns in the US sector, but currency shifts, sector dynamics, and disciplined diversification can create opportunities on a global scale.
Perfect. Well put. So that wraps up today's episode of Portfolio Playbook. Thanks for listening.